Welcome to the Daily Update. This is being prepared Monday, August 8th, where we'll look at the action in the market today and then see how things look for Tuesday, August 9th. We had a bit of a down day, and that's what we've seen over the last three trading days. A little bit down on Thursday last week, Friday last week, a little bit down in Monday's session. We're not really working off this short-term overbought condition according to some of our charts, but the fact that there's been some negative things thrown at the markets these days, and the stock market is holding up. Now, expect Tuesday's session to be kind of quiet. At least that's what it should be. Anything can always happen. But the big day right now is going to be Wednesday, and that's when the CPI comes out. And that's what the markets and pretty much everybody are fixated on right now is the inflation rate, which feeds over into interest rates. If we get a market-friendly report, this uptrend that we've been seeing would have a lot more support. If it comes in stronger than expected, this scenario of maybe inflation has topped out and is starting to come down, that gets put on the back burner and we could see some weakness. Whatever happens, we'll just be watching things to see the intensity, whether it's going up or down, or we're waiting for this and it might not be that big of an insight anyway, and the market just kind of chops around the way it's been doing recently. So this is how things often work in the stock market. There's this build up to some kind of an event, and then it happens, and then it turns out to not be that big of a deal. Where other times it is a big deal, either positive or negative. All right, so let's go back and talk about what happened on Monday. We had a pretty strong open. We gapped higher at the open, and we were able to get above R1 at 41.62 and even slightly above R2 at 41.79. What often happens is when we see a large move up or down, then we see a counter move to try to fill the gap. And that's what happened. Prices then ended up falling back down to the daily pivot at 41.35 in order to fill the gap. Once that happens, then the market needs to decide, are we going to bounce back up? Are we going to continue to go lower? Well, we took the third road on Monday, where we pretty much chopped sideways after that. So as the day went on, we mainly bounced back and forth between the unchanged level and the daily pivot, which was slightly negative. The pivot was below the unchanged level. Going into the close, we came up off of the lows a little bit, but kind of near the lows. Certainly not what had happened right at the open. We were down 0.12%. Volume dropped back down to below average. And it would not be surprising in Tuesday's session if we see kind of a quiet market on lower volume. Now, anything can happen while the market is open, but based on what we've been seeing lately and the anticipation that's building up, that's what we might end up seeing. The technicals, they're still positive. We're still looking okay on the daily charts. We're seeing a little bit of weakness. We're not seeing a real follow through with price yet. We went up and hit resistance and came back down off of that, but we need some more of a catalyst to help prices go higher and to get out of this little choppiness that we've been seeing. Of course, as I said, inflation and interest rates, which produces growth concerns, that's the real focus right now. Geopolitical things that are going on, any one of those could come to the forefront. Earnings are being released kind of at a feverish pace right now. And then we have a textbook definition of a recession, but with last Friday's employment situation report, it's throwing that kind of out of balance, and each side thinks they're right. So we're just kind of going with what we see on the charts right now. So what are some comments that we can make? There's a lot of anticipation with the CPI coming out on Wednesday. Another thing that came up in the news was Fed Governor Bauman, who is a voter on the open market committee, said that she sees another 75 basis point rate hike, or 0.75%, on the table for September. And that's pretty much what the market is expecting right now. If you watch the weekend video, I showed that there's about just under a 70% chance at that time that there will be a 0.75% rate hike at the meeting, but we still have a ways to go. We're still in the early days of August, and this meeting is coming up on September 21st, the first day of fall. At least I think it's on the 21st this year. Then we had this other thing that's been flying around the news. It went through the House first, and then the Senate ended up passing the Inflation Reduction Act, which, if you follow politics all that much, whatever they name it, it really is going to end up doing the opposite of that. It's just a play on words. And how that can affect the stock market is that there might be a 1% excise tax on stock buybacks from companies, which that could hurt the markets because now people are being taxed on that by 1% more than any kind of capital gains that they may be taxed on. And then there's a minimum 15% tax rate on corporate book income. And although there's an offset for depreciated assets, yeah, there's all these games that go on when it comes to taxes. What you're being told in the media, if you even listen to that anymore, is probably going to end up being a lot different. And that's historically what has happened. Not just right now. We're seeing it kind of on steroids right now with what we're being told, with what is really going on. But this is a political game that we see. And everything is presented as an answer, as doing something wonderful. Well, if you look under the surface, it's often quite different than that, whether you agree or disagree with it. We just want to focus on how is that going to impact the markets. And then China is continuing on with their military drills around Taiwan. And that's in the wake of the speaker visiting last week. Even though nothing really happened during that visit, there's some blowback that is occurring. And so this could escalate into a geopolitical concern on a higher level than it is if this back and forth yelling and screaming and saber rattling still continues. Then the sector rotation that we're watching, it's still holding up. It was down a little bit in Monday's session, but we're still above the moving averages, and I'll show you those charts. We still have a number of yield curves that are inverted. Fear is still at 50, so we're neutral. Oil is back down below 90. That is hopefully making people feel a little bit better. And we have the first reading of consumer sentiment coming out on Friday. We'll see if that helps anything that way. There weren't any economic reports on Monday. In our trend, we're still positive with the ADX and we're above 20. I've switched the bias over to mixed because we've had 3 down days now. They were minuscule. None of them was over, the 0.25%, but still they're negative nonetheless. And with some of our indicators, if we have a down day, everything switches over to negative for that calculation, where some are more mixed. They can see the up and the down within them, and then they calculate according to that. But because we haven't really fallen, even in the wake of some what could be considered negative news, that's why I'm keeping it at mixed, because the market held up fairly well. And then the momentum, I've also switched back to mixed for right now with a positive slant on things, because we're still looking positive, but we've now had a number of days where the markets really haven't done all that much on a close to close basis. So let's go back and look at sentiment. We're still at 50, which is the same place that we were at after Friday's session. And we're flattening out a little bit, but right in the neutral area. Here's another reading, which is showing it just slanted a little bit more towards the greed side of things. So in sentiment as a whole is really starting to improve. The other Isabel chart to show you is just showing that we're seeing an increase in the inflows of going into bonds, and they call this credit. And where you have investment grade, high yield, emerging market, all of that together is debt when people loan money to these various entities. And that had really been dropping off. Well, we're seeing that picking back up with the light blue line. And then we have the 4-week moving average. It is going back up as well. So that just means there could be some more support in the bond market. We're seeing money going back in to those instruments. This is the Fed funds futures curve. This purple line down here, this is what they thought it was going to be a week ago. And this blue line is what they're thinking right now. So this can change all the time over as we go back and forth with things. And then this is, what do they think the unemployment rate is going to be? And it compares all these different years recently with the red line down here so far for the gray line is 2022. The red line on the bottom is what they anticipated for 2023. Still very, very low. And again, as I said in some other videos, this is just a numbers game here. It doesn't tell us the quality of these jobs. It's just, if somebody was a CEO, I'm going extreme with the example, they were a CEO of a company and now they're flipping burgers at McDonald's, that still counts. That's not really measured as they went from a really good job to not as good of a job. So, but again, this is what the market uses to help make its decisions. So that's why we follow it as well. Here's just some recession probabilities. Looking at the S&P 500, it's about a 50-50 chance that we're going to stay or even go into a recession. This is the U.S. high grade credit. They're a little bit less. They think there's a less of a chance of there being a recession. The high yield credit is even less than that. The 5-year treasury, and then the base metals. This is one of the sectors. These are the things, I'm sorry, not one of the sectors. These are the things like the gold, the silver, because they haven't really been behaving as though we're really going into a recession. So that's why their probability is a lot higher. And here we have that same chart again. My arrow keys are having some problems apparently. And then this is kind of encouraging where corporate defaults, they're still at near all-time lows, where if the economy was really getting into some trouble, we would see a real spike up in the defaults. Well, that's not what's happening right now. We're still pretty low. People are being able to repay, and corporations are able to repay their debts currently. Then this is just showing the Fed tightening, that it's weighting heavily on credit growth. That kind of contradicts what we're seeing. We're seeing money going back into the bond market, but this chart is just showing that on a financial level from the banks, the total bank credit has really been declining. The commercial bank credit, it turned up a little bit, but when you look at the Fed bank credit, it's really getting to a very low level right now. It's kind of a money tightening type of situation. It's not as freely available. Here's another updated chart of the jobless claims. The dark blue line is where we're at right now. We've been kind of following the seasonal trends over a time. It spiked up a little bit and now could be coming back down as we get into the later months of summer and into the fall. So we just want to keep an eye on this because we're watching the employment situation right now, since that's what a lot of folks are really focusing on to say, no, we're not in a recession. Then here's the closing values for the value growth analysis. Growth ended up being down, so it underperformed, where value was actually up a little bit in the session, and all of the other areas. Growth did outpace in the mid caps, but it underperformed in the small caps. So we're kind of seeing a little bit of a mixed picture on the daily basis, and then I'll have the charts to show here in just a second. The VIX is pretty much flat from Friday to Monday, both with the line chart and the bar chart. And then here's the VIX of the VIX. It spiked up a little bit, and it might spike up a little bit more as folks may decide to start hedging things ahead of the CPI report on Wednesday. We're seeing a continuation of the drop-off of folks in the Ridex bearish funds. That's continuing to decline as they choose to get into the more bullish funds currently. The Ulcer Index, the daily chart, still is not really telling us anything. So I've been looking at the weekly chart where, as we're coming down in fear with our other gauges, we're seeing this weekly chart also continue to decline. We're down 14.08% from the all-time high. The equity put call ratio actually declined a little bit in Monday's session, and the 5-period average is also showing a decline. Here are the pivot points for Tuesday's session. If you want to just pause this, if you end up using these, I use these very heavily, but they're automatically drawn on my charts. with the values and everything already pre-calculated. Here's the daily chart showing that we're still below average with volume. We came right up to this resistance level and then back down off of that. We hit that pretty much right at the open. So we're going to need some kind of a catalyst that will get, if things are positive, to really get us to be able to shoot above this level. Right now, this is noticeable resistance in the market. It may not end up happening in Tuesday's session, and we'll have to see. Will we be able to break above that if the report is taken as positive? Here are the pivot points for the month of August with the new bar added for Monday's session. We haven't really done much here with our retracement levels because this is also the resistance that the market is starting to run into. Our sectors, the technology sector, since we had a down day, that's how I sorted these. Tech was down, the financials were down a little bit. Then it was kind of a mix of things. Nothing was really up or down more than 1% as far as our sectors. And the scooter scores, we have two. The utilities and energy continue to have pretty strong looking technical analysis charts, where communication is still looking the weakest. Here are the sectors with energy still in the lead. Utilities have been bouncing back recently. And we have communication all the way in last place, which has recently replaced discretionary. Here are the indexes going back to the all-time high. Not really any changes there. They kind of jockey back and forth a little bit, but they're showing some improvement from the lows that we set in June. We do have some technical alerts this time, where the NASDAQ and the Dow went above and below certain levels. There are no alerts as they apply to the S&P 500. We had oil crossing above 90, but then in the slight after hours market, it dropped down below 90. Here's our intraday chart where we really spiked up above R1 all the way up to R2, even got above R2. And that was the high for the day. We stalled out at that point, going sideways. Then there was an attempt to come down and fill the gap. At first, we came almost down to the unchanged level, tried to bounce up off of that. That didn't work. Then they came all the way down to the pivot, and this ended up providing support for the market. We came up a little bit going into the close, but it was still well off the high that had been set. Our trend is still positive with the green line on top and advancing. The ADX is above 20 and above the moving average. We're seeing a decrease in the selling pressure. The Arun also shows buyers in control with selling declining. So overall, we're seeing our oscillator show a slight improvement. Breadth, bit of an advance on price and flat to slightly down based on volume. The advance decline ratio ticked up slightly. New highs, new lows. Even though we're not seeing a real breakout in the raw scores up above, our 5-period moving average is moving up, where our 10-period is a little bit up to flat. Accumulation distribution declined, but is still above an advancing moving average. Short term, we had a little bit of a change with the decision point market scorecard, where the PMO signal this is more intermediate term, has switched over to positive after Friday's session. And no, this was last week. But we have the short and intermediate term are more positive, but the longer term is still suffering. And that's kind of what we're seeing right now with our charts as well. Here's our moving average tree. We're coming right up to the 200-day moving average. Isn't that interesting? We have already established resistance, and the 200-day is this exponential. Yeah, the exponential moving average, all converging at the same place. Isn't that interesting? That is one of the reasons why I use technical analysis very heavily. We didn't have enough to really break us through, so the market ended up coming back down. Can we break above this? That would be quite positive. Stochc RSI still looking extreme positive, even though it's been declining. Same thing with the Williams percent R. The force index is declining and it's right in the middle of this Keltner band right now. The Swinland trading oscillator, flat to slightly down based on price and still declining based on volume. McClellan oscillator turned up slightly, where the moving average study, a little bit up with the 20, a little bit up with the 50, and slightly down with the 200. Stochastics, and these have just been kind of pegged in the overbought conditions, both short, intermediate, and long term. Some of our intermediate charts show us that we're still above the 100 period moving average. If we do fall, will one of these, if not both of them, end up providing some kind of support? And then the Sean trend meter ticked up slightly. PMO looking positive based on price and volume. PMO study, a little bit of an advance with the PMOs that are rising, declining with the buy signals, and still advancing with those PMOs that are above zero. Chaikin oscillator showing a little bit of continued weakness. Chaikin money flow also declined slightly. Volume is dropping off. And again, I just want to warn you that we might see a low volume day on Tuesday. You might not have a lot of folks that want to take big positions ahead of such an influential report on Wednesday. The Vortex still looking positive overall. Summation index advancing based on price and volume, although it's rolling over a bit with the volume. All of our oscillators continue to be positive. The BPI continues to be positive, a little bit extreme, but it's been hanging in there lately. Ease of movement showed a little bit of a decline. Ultimate oscillator also a decline. We're still at the upper side of our intermediate term rainbow. Money flow flat to slightly down. The TTM squeeze still continues to be positive. These pale blue lines that are going through this histogram, it's continuing to advance. So that's still looking more positive. Our different charts, Heikin Ashi, still looking okay. The Kegi is still positive. The Renko is still positive. The three-line break is still positive. No changes on the point and figure chart, and it's been looking more positive with the triple top breakout signal. Our different trading systems, the Elder is neutral for both the SPX and the SPY. The SAR continues to be positive. The go, no-go system continues to be positive. Long term, we're still roughly in the middle of this longer term moving average rainbow. Really not much of a change with our longer term moving average study, ticking up slightly with the 50, 150, and 200. Special K, still trying to see if it can get going a little bit higher. The diamonds are back to neutral. Here's the Dow, where this bar looks a little bit scary because we opened, went up, and then came back down. But we'll just have to see if there's any follow through to this. The Qs are back to neutral. NASDAQ 100 also closed near the lower part of the bar. The Vixen ticked up slightly, but not all that much. And here's the NASDAQ, also closed near the low of the bar. Strong open, weak close. Mid caps, same thing, even though they were up 0.63%. And the Wilshire was barely up at 0.06%. Looking at the broad market, the dollar was down slightly, but still in an overall uptrend. Here's the correlation. We're seeing this correlation start to wear off slightly. So they're not necessarily going in opposite directions. This could always change, but this is starting to wear off. Gold had a pretty good day. It's still coming back and dealing with the 50 period moving average, even though gold is still in a downtrend. Silver had a stronger day. It was able to break above its 50 period moving average, but it's also still in a downtrend. Oil is now, I guess it did drop to about 90 or so. And here's the correlation between oil and the S&P. Kind of a strong inverse relationship, but not really strong. Looking at bonds, they were up 0.45% with our total bond ETF. That could help things to see bond prices going up and stocks going up together, since that would mean interest rates would be going down. The world bond index was also up a little over 0.25%. And our yield curves, we still have the same ones. The 10 to the 5 is negative. The 10 to the 2 is negative. We're still keeping an eye on the 10 to the 3 month. It's just dancing barely staying positive with its curve. We'll see if that goes inverted. The tech sector, the 10-year yield, is coming back to almost a neutral reading right now, where we saw a little tick down with the longer term maturities, but a spike up in the 2-year maturity. And that's throwing one of our scenarios still into check right now. This positive setup is still holding up with the stocks in the S&P above their 200-day simple moving average. Here is the 50-period moving average still holding up with the S&P, with the mid caps, and with the small caps. The 10-day average of the S&P 500 highs and lows still holding up after giving us a positive setup reading. The equity put call ratio continues to decline on a moving average basis. That signal is still holding up. Small caps, they actually did probably better. They were up 0.63% in Monday's session. So that helped the ratio a little bit between the small caps and the S&P 500, which is producing a little bit of a spike right here with the small caps. That could give some support to the S&P 500. Then looking at the S&P 500 to the 10-year yield, getting back to almost a neutral reading where they had been going in a more solid opposite direction. Copy curve still, it's rolling over, but still giving us a signal. Here is our sector rotation. We saw a decline both on Friday and Monday, but we're still above the moving averages. A little bit of a tick up with discretionary, but a decline with the growth versus value with the large caps. And then looking at the large, mid, and small caps, they're still above the moving average, even though we saw a bit of a decline. The correlation between the S&P 500 and the 2-year yield, haven't shown this in a while because we were in neutral territory for some time, but they're starting to look like they're moving in the same direction right now. And here's our spike. We're really close to this 2-year yield spike. It's really hard to know, is this going to be valid? We really want to see this begin to fall in a big way, and it's just not doing that right now. So this positive scenario, I wouldn't make it as positive right now. And here's the same chart again of the correlation. Why are my arrow keys not working? The staples were down slightly, and this to me is the stronger setup that we're looking at. We're still seeing the staples to S&P 500 ratio continue to decline. So what's our outlook for Tuesday? We're positive, but we're still trying to work off that short-term overbought reading, and we're really not doing much of anything right now as far as price action. There's action during the day, but on a close-to-close basis, we're just not seeing very much. Sentiment is neutral right now. We've got the CPI coming out that I've mentioned a number of times. On Tuesday, we have the preliminary readings for productivity as well as unit labor costs. Not a big one unless it's a really, really wild report, but a lot of folks are going to be waiting for Wednesday. And then all these other crazy geopolitical events. Right now, in spite of all the things that are going on, is from a stock market perspective, it's in inflation and interest rates that are the biggie. But any one of these could change and become headline news. So our scenarios, we're not really going down, but we might if the CPI comes out unfriendly. The technicals, they're positive, so we're fighting against that if you're more bearish right now. We still are up. There's a real disbelief and this fear of missing out. But again, folks are waiting for the CPI to come out. Our scenarios, for the most part, are holding up. There's a few that have been weakening with this little choppy environment that we've been seeing. The technicals are still looking pretty good. And we're now dealing with the 200-day moving average, which we haven't dealt with in a long time. Can we break above that? We're not going sideways according to the ADX because it's above 20 and it is positive. So our conclusion then is, and this is pretty much the same, the S&P, it's positive and so far has been holding up. Can that hold up continue? Can that hold up lead to an advance? Short term, looking positive and still slightly overbought, especially when you look at the stochastics. Intermediate term continues to be positive, a few little weakening charts in there, but we're still negative with the long term. So thank you. Have a wonderful Tuesday, and I will likely prepare a video. If we have a really slow day on Tuesday where not much is really decided, I may not do a video for Wednesday, but believe me, we will be doing one after Wednesday's session. So have a great day.